Imagine 1,500 turning into $50,000. Not overnight, but through the quiet storm that most investors still don't fully understand yet. Some folks chase the latest tech fad, but the real money historically is made where common sense meets scarce. And today that story is being written in physical silver, the metal that's waking up from decades of dust, ready to take its place as one of the most powerful wealth preservers of our generation. Most investors miss the biggest opportunities, not because they're risky, but because they're uncomfortable. They sit quietly, ignored, misunderstood, and pushed aside while capital floods into whatever is popular at the moment. That's exactly where silver sits today. It's not flashy. It doesn't make headlines every day. And because of that, it has quietly become one of the most undervalued assets in the financial landscape. When markets are running hot, people chase growth, stocks soar, speculative assets explode, and confidence turns into complacency. But history shows us something very important. The real money is rarely made at the top of excitement. It's made when an asset is overlooked, discounted, and fundamentally strong beneath the surface. Silver fits that profile almost perfectly right now. For decades, silver has lived in the shadow of gold. Gold gets the attention, the headlines, the prestige. Silver gets treated like its lesser cousin. But that perception is exactly what creates opportunity. Silver isn't just a monetary metal. It's an industrial necessity. It's used in electronics, medical equipment, solar panels, electric vehicles, and emerging technologies that are shaping the future. Unlike gold, much of the silver that's mined doesn't sit in vaults. It gets consumed. Once it's used, it's often gone for good. That alone changes the supply equation dramatically. Now add another layer, supply constraints. Silver production hasn't been keeping pace with demand. Mining grades are declining, extraction costs are rising, and new discoveries are becoming harder to find. At the same time, global demand continues to climb steadily. That imbalance doesn't resolve quietly. Markets eventually respond, and when they do, the move can be fast and aggressive. What makes silver truly compelling is how disconnected its price is from its fundamentals. When you look at historical ratios, purchasing power, and inflation-adjusted values, silver remains far below where it has traded in previous cycles. That doesn't mean it has to repeat history exactly, but markets tend to revert toward fair value over time. And when they do, undervalued assets don't creep higher. They reprick. Most people wait for confirmation, and they wait until silver is already moving, already trending, already being talked about everywhere. But by then, the opportunity has shifted. Early stages are uncomfortable. They feel boring. They feel that's where discipline comes in. Understanding value before the crowd does is never exciting in the moment, but it's incredibly rewarding later. There's also a psychological element at play. Investors are conditioned to believe that higher prices mean higher opportunity. In reality, lower prices with strong fundamentals offer far better risk-to-reward setup. Silver today is priced like an afterthought, yet positioned like a necessity. That disconnect is rare, and it doesn't last forever. Another factor that can't be ignored is confidence in financial systems. When trust erodes, whether through inflation, debt expansion, or currency debasement, hard assets start to matter. Again, silver has played that role throughout history, not as speculation, but as preservation. When paper promises weaken, tangible value regains importance. This isn't about predicting tomorrow's price. It's about recognizing where value exists today. It's about positioning before the shift, not chasing after it. Silver doesn't need hype to perform. It needs awareness. And once that awareness spreads, the revaluation can be dramatic. Undervalued assets don't stay undervalued forever. They either improve fundamentally or the market wakes up to reality. Silver is already doing the former. The latter is only a matter of time. The biggest moves in markets rarely begin with excitement. They begin with silence. And right now, silver is very quiet. There's a critical distinction most investors never fully appreciate, and it's the difference between owning an idea and owning reality. In today's markets, that difference shows up clearly in the divide between paper exposure and physical ownership. The surface both appear to track the same price, But underneath, they represent two very different forms of risk, control, and value. Paper silver is convenient. It's easy to buy, easy to sell, and it fits neatly into brokerage accounts, futures contracts, ETFs, derivatives. They all promise exposure to silver's price movement. But here's the problem. Exposure is not ownership. Paper instruments are claims, agreements, and promises that depend on counterparties' systems and market liquidity functioning exactly as intended. Physical silver doesn't rely on any of that. It simply exists. When markets are calm, paper and physical seem interchangeable. Prices move, charts update, and everything feels efficient. But stress has a way of revealing weaknesses during periods of volatility. Liquidity tightens, spreads widen, and paper markets begin to behave very differently than the asset they're supposed to represent. That's when investors realize that owning a symbol on a screen is not the same as owning the metal itself. Physical silver carries weight, literally and financially. It represents real scarcity. There is only so much silver above ground, and much of it is already locked into industrial use. Unlike paper contracts, physical silver cannot be created with a keystroke. It must be mined, refined, transported, and stored. Every ounce has a cost behind it, and that cost sets a natural floor under a long-term value. Paper markets, on the other hand, can expand far beyond physical supply. Multiple claims can exist on the same ounce of silver, creating a leverage effect that suppresses price discovery. As long as most participants settle in cash and never demand delivery, that system holds together. But when confidence shifts and demand for physical delivery rises, the imbalance becomes impossible to ignore. This is where the true power of physical silver emerges. When investors move from speculation to preservation, they stop asking, what's the price today, and start asking, can I actually get the metal? That shift in mindset changes everything. Premiums rise, inventories thin, availability tightens, and suddenly the paper price becomes less relevant than the real-world cost to acquire silver. Physical ownership also removes layers of risk that most people underestimate. There's no counterparty risk, no margin calls, no trading halts, no dependency on financial intermediaries. Ownership is simple and direct. That simplicity becomes incredibly valuable when systems are stressed or trust begins to erode. This isn't about fear or extreme scenarios, it's about structure. Markets are complex, interconnected, and highly leveraged. When disruptions occur, whether from economic shocks, policy shifts, or liquidity events, assets with fewer dependencies tend to perform differently. Physical silver sits outside much of the financial system, and that separation is a feature, not a flaw. Another overlooked aspect is behavior. Paper silver encourages short-term thinking. It invites trading, speculation, and emotional decision-making. Physical silver encourages patience. You don't day trade bars and coins. If you hold them, that shift alone aligns investors with long-term value rather than short-term noise. Over time, markets tend to reward what is scarce, essential, and tangible. Silver checks all three boxes. It's scarce relative to demand, essential to modern industry, and tangible in a world increasingly dominated by digital representations of value. Well, when that reality becomes more widely recognized, the premium placed on physical ownership can expand dramatically. The irony is that physical silver is often dismissed because it doesn't move fast until it does. When revaluations occur in physical markets, they tend to be sharp and decisive. Supply cannot respond quickly. Mining can't scale overnight. Inventories can't magically refill. Prices adjust instead. At its core, the choice between paper and physical silver is a choice between convenience and certainty. Paper offers speed and simplicity. Physical offers control and permanence in an environment where uncertainty is rising and systems are increasingly stretched. That difference matters more than ever. Owning physical silver isn't about predicting collapse or timing markets perfectly. It's about understanding the structure of value and positioning accordingly. When the gap between paper promises and physical reality widens, those holding the real thing are no longer asking questions. They already have their answer in hand. Markets don't move randomly. They move in cycles driven by psychology, capital flows, and long-term structural shifts. Most investors focus on short-term price action, but the biggest opportunities emerge when you step back and recognize where you are in the broader cycle. Precious metals and silver, in particular, have always followed this pattern. Long periods of neglect are followed by sharp, powerful advances that catch the majority off guard. Silver has spent years doing very little on the surface. Prices moved sideways, enthusiasm faded, and attention shifted elsewhere. That kind of behavior is not a sign of weakness, it's a sign of accumulation. Historically, when an asset trades in a wide range for an extended period, it allows strong hands to build positions quietly while weak hands lose interest. Once that base is complete, the breakout phase tends to be decisive. If you look back at previous metal bull markets, the early stages never felt obvious. They felt frustrating, rallies were short-lived, pullbacks were common, and sentiment remained skeptical. That's exactly how major trends begin. The market tests patience before it rewards conviction. Silver's past cycles reflect this repeatedly, and the current structure shows many of the same characteristics. What drives these cycles is not just price, but conditions. Monetary expansion, rising debt levels, and diminishing confidence in fiat systems create an environment where hard assets regain relevance. These forces don't act over, they build slowly, almost invisibly until the pressure becomes too great to ignore. When that happens, capital shifts rapidly. Silver often lags at the start of these transitions. Gold typically moves first, drawing attention to the sector. Silver then follows, but when it does, it tends to move with greater intensity. That's not coincidence. Silver's smaller market size and tighter supply amplify price movement once momentum takes hold. This is why silver bull markets are remembered not for their duration, but for their speed. Another important element of cycles is perception. During barren basing phases, negative narratives dominate. Silver is called volatile, unreliable, or irrelevant, but narratives change quickly once price confirms strength. What was once ignored becomes strategic. What was dismissed becomes essential. That shift doesn't create the move, it follows it. Technical structures often tell the story before headlines do. Long-term charts reveal compression, higher lows, and breakout patterns that reflect growing pressure beneath the surface. These patterns don't guarantee outcomes, but they do highlight probabilities. And when probabilities align with improving fundamentals, the risk-to-reward profile changes dramatically. Industrial demand adds a unique layer to silver's cycle. Unlike purely monetary assets, silver is consumed. Each technological advancement that relies on silver tightens the supply chain just a bit more. Over time, that consumption compounds. It reduces available inventory and increases sensitivity to demand spikes. Cycles driven by consumption tend to be less forgiving on the upside because supply cannot respond quickly. It's also worth understanding that cycles are emotional. Investors tend to extrapolate recent performance far into the future. When silver underperforms, it's assumed it always will when it begins to outperform. Enthusiasm accelerates quickly. This emotional swing is what fuels latest stage rallies, but by then, much of the move has already occurred. The disciplined approach is to recognize the cycle early and act before consensus forms. That requires patience and a willingness to be uncomfortable. It means accepting periods where nothing seems to happen. But history shows that these quiet phases are the most important. Cycles don't ring a bell at the bottom and they don't announce themselves at the beginning. They reveal themselves through structure behavior and gradual shifts in capital flow. Silver today shows many of the characteristics seen at the early stages of past bull markets. Extended basing, improving demand dynamics, and increasing sensitivity to macro pressures. When the next phase fully unfolds, it will feel obvious in hindsight. Prices will move faster than expected. Stories will change, participation will surge, and those who recognize the cycle early won't be chasing. They'll be managing positions. Understanding cycles isn't about predicting exact timing, it's about alignment. When long-term trends, structural demand, and market psychology begin to move in the same direction, the opportunity becomes asymmetrical. Silver has spent years preparing for that moment. A cycle doesn't need attention to continue. It only needs pressure. And pressure over time always resolves emotion. When we talk about big opportunities in markets, it's not enough to just look at historical trends or macro factors. To really understand why an asset can move from modest sums to extraordinary gains, you have to look at it drives value from the inside out. For silver, the story isn't just about price. It's about real-world utility, scarcity, and the forces that can amplify demand over time. It's about understanding the invisible levers that push value far beyond what most investors imagine. Industrial demand is one of the most powerful of these levers. Silver is not just a precious metal for investors. It's a critical component in a growing number of technologies that are transforming the global economy. Solar energy, electronics, medical devices, and electric vehicles all rely on silver's unique properties. Unlike gold, which primarily functions as a store of value, silver is actively consumed in the creation of products that power modern life. Every ounce used in industry is an ounce that cannot return to the market easily. That scarcity has a compounding effect over time. And there's the monetary dimension. Silver has been used as a store of value for thousands of years. In times of uncertainty, when fiat currencies lose purchasing power, the appeal of holding tangible assets grows exponentially. Investors often underestimate how quickly sentiment can shift when confidence in paper money wavers. Physical silver doesn't just represent wealth, it preserves it. And when more people recognize this, the demand curve steepens sharply, putting pressure on a market that is already limited by finite supply. Supply constraints add another layer of complexity. Mining production is not only limited, it's becoming more expensive. Oil grades are declining, extraction costs are rising, and geopolitical factors can interrupt supply chains unexpectedly. Unlike financial instruments that can be created out of thin air, silver cannot be manufactured on demand. This inherent scarcity combined with rising demand from both industry and investors sets the stage for outsized price appreciation. Timing is another factor that separates average returns from extraordinary ones. Markets often move slowly at first, then rapidly as trends compound. Those who enter early when fundamentals are quietly building have the potential to capture the majority of the move. This is not speculation, it is positioning. It is a disciplined recognition of value before the crowd catches on. The mindset is simple. Identify asymmetrical opportunities where risk is defined and reward is open-ended. Silver today represents one of those rare opportunities. Behavioral dynamics play a role as well. Most investors are driven by emotion, fear, and greed, dictate buying and selling patterns. Early in a trend, skepticism is high and enthusiasm is low. Those willing to act when others hesitate often gain the most. As price begins to reflect real-world scarcity and industrial use narratives change quickly, suddenly, what was ignored becomes essential. That shift in perception can drive sharp, almost vertical moves in value, creating wealth for those positioned ahead of the curve. It's also worth noting that silver has a unique leverage built into its market structure. Because it is smaller than gold and less liquid than many mainstream assets, modest flows of capital can have an outsized impact on price. That doesn't make it volatile in a reckless sense. It means that fundamental shifts like rising industrial demand or increased investor interest can produce dramatic repricing when conditions align. Long-term wealth creation in silver requires patience and conviction. The most powerful moves often occur when the majority of investors are still questioning the story, when headlines are absent, and when conventional wisdom dismisses the metal as irrelevant. History has shown that these quiet periods of accumulation set the stage for explosive growth once scarcity, demand, and recognition intersect. Ultimately, moving from a modest starting point to extraordinary gains is about understanding the forces that drive value beyond surface-level price movements. It's about recognizing scarcity, structural demand, and timing your participation in a market before it becomes obvious to everyone else. Silver offers this combination as tangible, scarce, consumed in real-world applications, and poised to benefit from macroeconomic conditions that favor hard assets. When these elements converge, they create an environment where disciplined investors can potentially capture significant upside. The path to substantial gains is rarely linear, and it rarely feels comfortable in the moment. But by focusing on the fundamental drivers of value, understanding supply constraints, recognizing industrial demand, and positioning for asymmetric opportunity, that becomes clear. Silver isn't just another commodity. It's a strategic asset whose real-world relevance and scarcity create a rare opportunity to participate in wealth creation at a scale few other assets can offer. Those who see it, understand it, and act accordingly are the ones positioned to benefit when the market finally catches up to reality. So when you hear from $1,100,000, don't think fantasy, think discipline, timing, and conviction. Physical silver isn't a gamble. It's a strategic stake in the future of money scarcity and global demand. The winds are changing, old paradigms are shifting, and those who understand the true power of physical silver, those are the ones who stand to redefine wealth for themselves.